What three stocks do I think are set to outperform the market in June 2017 and for the rest of the year and the upcoming years? Find out in today's video on three stocks to buy in June 2017. All right, so the first company that I think is set to outperform the market in June and for the rest of the year is Gilead Sciences. So here's a look at them on Morningstar. Their market cap is $85 billion. They pay a 3% dividend yield, and they have a forward price to earnings of 8.7. So their current price to earnings is a 6.8. And they have very good margins. 57.6% operating margin and net margin of 43.4%. So that's always nice to see. So pretty much they're a large maker of hepatitis C treatments and HIV treatments, as well as a few other things. So recently their hepatitis C revenues have fallen significantly. That is because their hepatitis C treatment actually cures the patient of hepatitis C after 8 weeks of the treatment, and it ends up costing about $80,000 for this treatment, but it cures the person. And so they have actually cured a significant amount of their patients, and that has led to a decrease in these revenues, and their stock prices dropped significantly due to this. But I think that the drop in their stock price has been a little bit exaggerated, and I will explain that now. So let's just quickly look at their recent, or at their guidance for 2017. So they're guiding for $22.5 billion in sales, and $15 billion of that from non-hepatitis C, and then about $8 billion of that from hepatitis C. So that means that hepatitis C makes up around 1/3, or about actually 35% of their business. Okay, so let's take a look again at their earnings. So they had an earnings of about $10 per share in 2016, and they have about 1.358 billion in shares outstanding. So let's assume that they lose all of their hepatitis C sales and do the valuation of their business without hepatitis C at all. So we will start by taking their earnings per share and multiplying that by 0.65, which will bring us to their earnings per share without hepatitis C factored in. So that will give us about $6.5 in earnings per share. And then we'll multiply that by 1.358 billion to get their total earnings without hepatitis C based on their 2017 guidance and their earnings from 2016. So that will give us $8.7 billion in earnings without their hepatitis C factored in at all. So now we are going to multiply that by a reasonable price to earnings ratio that a company would trade at. So let's say 10. And that gives us $87 billion. And if you look at their current market cap, it's $85 billion. And so pretty much they're trading at a valuation about equivalent to if they didn't have their hepatitis C franchise at all. And I'm just doing that because their HIV and other product sales have been growing a lot recently. And so that's a healthy business. Their hepatitis C is struggling. But the market has pretty much completely priced out their hepatitis C franchise. And I think that's unfair because it's still generating large amounts of income for them. And I think there's a large opportunity for Gilead to expand their hepatitis C to China. So Gilead has not done any hepatitis C sales in China, but they disclosed manufacturing plans on a recruitment website for their hepatitis C treatment. So this is just an article on it here. But this pretty much means that they're going to be expanding their hepatitis C sales into China, which is a massive market for hepatitis C treatments, and that could pretty much bring them back to where their hepatitis C sales were in the US back in 2014 when they first launched that. And then I don't think that this China manufacturing of their hepatitis C stuff is really going to come until 2018 or 2019, so it's kind of a more long-term thing for Gilead, but I think that once they get that out, that will definitely increase their earnings and subsequently increase their share price. So we'll just quickly look at their earnings per share. And so their earnings per share have been dropping quite significantly, and their prices dropped along with it. But I do believe that their prices dropped to unfair levels that value them very cheap. And so pretty much all Gilead needs to do right now in the short term is announce that they're acquiring someone. The market really wants Gilead to acquire another company, and if they do that, it will make their shares jump by about 10%, I believe. So let's just quickly look at their chart. So Gilead has fallen from highs of $122 per share down to $64 per share, and so that's a massive drop. But I think it is unfair, like I have said before, and I think that they're set to rebound pretty soon. So now we'll look at Gilead's pipeline here. One of the main things is NASH, which is pretty much non-alcoholic fatty liver disease, and a lot of companies are working on treatments for this, but I think Gilead is set to be one of the first 2 or 3 companies to market with their non-alcoholic fatty liver disease treatments, which will definitely increase their earnings, so that's a great prospect for Gilead Sciences as well, but that again won't be coming until probably 2018 or 2019. So I think that Gilead will likely outperform in June due to their significant fall in share price, and I think the market will correct. But I'm not sure if they're going to really outperform for the next couple months, but I think in the long term, so the next 3 years, Gilead is going to be a tremendous investment that is just being looked upon poorly by the market right now because its shares have been hammered and nobody's really wanting to jump into a stock that's had its share price cut in half. But I think that in the next 2 to 3 years, they're going to significantly outperform the market. So the next stock that I think is going to outperform the market is Realty Income. So I've already done a actually really long video on why I think Realty Income is set to outperform the market. So I will be linking that in the description as well as putting a card with a link to that video if you want to check that out. So I'll just briefly go over why I think they're going to outperform the market. So Realty Income is a retail REIT, and those have been hammered recently because Amazon is taking a lot of the business from retailers, and that's causing retailers to struggle. But I think that Realty Income is pretty immune from this because of their customer base, and so I think that that's going to cause Realty Income to significantly go up in price to correct from this drop here. I think that they're trading at a pretty low value, and they really have gotten hammered recently, so I think that they're set to outperform the market for quite some time. So the third stock that I think is going to outperform the market in June and for the rest of the year and for quite some time is Phillips 66. So if you look at Phillips 66, they have a 3.3% dividend yield. They have a $40 billion market cap and a forward price to earnings of 12.5, as well as a price to book of 1.8, which is always nice to see. Just looking down here, they do have a 25 price to earnings, which is pretty high, but I'll go into why I think that they're still a good value play in a minute. So we look at them, they have low debt, they have better margins than their competitors, and so their earnings have been dropping as the oil refining business has been struggling. So they have definite earnings drops, but they actually beat analysts' I'm just going to get rid of the share price really quick. So they beat analysts' expectations by quite a bit. People were projecting 5 cents per share, and they had 51 cents per share. And so this is because their chemicals business has actually done very, very well recently. So their oil refining business has been slowing down, but their chemicals business has been doing tremendous, and that has led to good earnings per share. So as the oil refining business starts to grow again, as oil starts to improve, they will have a significant boost from that. And I think that that is why their earnings per share are definitely getting bumped up a lot by analysts. So good projections for the next 2 quarters. So let's just quickly go to their chart. They've been just trading in this range since February. And so I think that they're definitely going to be going up again as they start to get more earnings from their oil refining, and then also they'll have solid earnings from their chemical business in the future as well. So those were 3 of my picks for June. What do you guys think? Are there any stocks that you guys are buying or looking at right now? Leave a comment down below, and don't forget to like and subscribe. Thank you very much for watching.